Hey, it's Dan Morales, America's Mortgage Man, and I wanted to do a really quick episode of Homebuyer Radio. I wanted to talk about a recent change that was put out by the Federal Housing Finance Agency. Now, most people, of course, have no idea who the Federal Housing Finance Agency is. Well, they are the governing body that oversees both Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac are the two biggest sources of mortgage money for those of you who are looking to take out a conventional mortgage. So, that money ultimately, in most cases, is going to come from Freddie and Fannie in some way, shape, or form. Okay, so what does it matter to you as the American consumer? Well, the big change was you just saw a massive price increase across the board for really most consumers. Now, if you're in the low to moderate income, segment, you actually got a little bit of a pickup in a couple areas. But for most American consumers that are looking to take out a mortgage, your cost to borrow just went up. And that's especially true if you're somebody that's shooting for a 20% down payment. Now, of course, you would think to yourself, well, why would they charge me more if I'm putting 20% down? Well, what happens is that's actually a transaction that is still considered to have a fair amount of risk. Now, when a client has a down payment that's less than 20%, you normally have to deal with some form of mortgage insurance. And mortgage insurance does offset some of the risk that the lender has. And so in some cases, you can actually see a loan with a smaller down payment price better than a loan with, let's say, 20% down. Well, long story short, there's about 9 pages of price adjustments that apply on a conventional mortgage. Stuff such as your down payment, your credit score, the type of transaction you're doing, the type of property you're financing, how many units does the property have, what's the occupancy? Are you going to occupy the property as a primary residence, or is it an investment property or a second home? All of these different things factor into a price that you would get when you go to apply for a mortgage. Now, a lot of times clients like to look on websites and they like to get an idea of what mortgage rates would be. Let's say, just kind of, perusing or looking through a website to see what mortgage rates would be for them potentially. Well, there's so many variables that go into, what a loan would or what a rate would be. That's going to be really important that you have a detailed conversation with your loan officer about what options are available to you, because one of the new price categories that's out there now is debt to income ratio. Now, where this can really kind of come back to bite somebody is if you have a debt to income ratio that is close to that 40% threshold. If let's just say when you do your initial pre-approval and the lender makes some assumptions about what your estimated taxes would be and homeowners insurance and stuff like that, and they calculate numbers for you to give you an estimate based on the assumption that you're going to be, let's say, a less than 40% debt to income number. Well, once you buy the property, perhaps interest rates have gone up some, or perhaps the property taxes are a little bit more expensive for this property than what you were anticipating when you did your original rough numbers. Or maybe even your homeowner's insurance was more expensive, or now it pushed your debt to income number over 40%. Well, it's going to result in a price increase to you as well. So there's a lot of variables that are going to make it a little more tougher for us lenders to be able to put our arms around what you're actually eligible for, what the terms would look like, and so on. So more often than not, you might find your lender would try to paint a scenario for you that is maybe worst case scenario to try to protect you as you go out there and you're looking at properties, so that you have a reasonable expectation of what to expect. Now all of this, keep in mind, is in addition to the volatility that we see in the mortgage market as a whole, meaning that you can have, let's say, a 9-page form of price adjustments that apply to determining what your interest rate would be. But in addition to that, you have market fluctuations, which is just the volatility that you can have in the mortgage market, which is completely separate from these 9 pages of price adjustments. So it can be like trying to hit a moving target when it comes to giving you a quote for a mortgage, because there are so many variables that come into play, and a number of these variables are new variables. They're things that we have not had previously, such as a debt to income adjustment for pricing. The pricing grid for loans is now expanded, where you have to have a 780 credit score to get the absolute best price. There's a lot of borrowers that aren't even close to that. So there's a lot of variables there. There are a couple of silver linings in this. For those clients who are eligible for what would be considered a low to moderate income type of loan, You actually have, like I said, some price improvements that can benefit you. So it's going to be really important that you're connected with a good lender that understands how all of these pieces can work to make sure that you have the best loan structure that gets you the best overall price when it's all said and done. Hey, I'm Dan Morales, America's Mortgage Man. My NMLS number is 709729. My phone number is 616-931-4629. And of course, the Dart Bank is an equal housing lender. If we can ever help you out, hey, we do lend in all 50 states. We'd love to work with you on a mortgage, regardless of what state you're in. And there's a number of different ways that we can structure loans that would hopefully get you a little bit better price when it's all said and done. So we'd love to connect with you and help you out if we can. Have a great day. Talk to you soon.